Hello and welcome to KYC. I am Sharad Dubey and you are watching NDTV Profit. Also, let's guess the company which will be coming today in KYC. And the first hint I would like to give you is it's one of the largest steel wire manufacturers in the country. Also, the second important hint which would be there, that would be that the company operates in the infra and the automotive segments and a lot of other segments as well. But these are the new areas which they are focusing as well. They recently came out with their quarterly sales number and they were at the highest levels in the third quarter. So we will be asking the management what led to this growth. And the stock, however, is on a punishing mode. It's down 20% in the last 6 months. Why that has happened? But keep guessing the company, and I would like to point out the company which we are in focus is Bansal Wire Industries. This is the company which we are talking about, the Bansal Wires, and this is what we'll be looking after. But there are key questions. Why have we called this company? A lot of news flows are coming in and likely their volume growth guidance, that's what I'll be interested because they have posted some good numbers. Also going ahead, other important guidances which will be important will be the revenue and the EBITDA guidance which we'll be looking out for the company. And interestingly, the company is shifting to its specialty product portfolio as well. So that's something which we'll be looking out as well. The margin and the revenue guidance ahead, we'll ask Pranav, where does the company actually go from these important levels? And also, apart from this, the expansion and the capacity plans, that's very much important. Company is going through some specialty products which are there in that capacity additions which are happening. Also, apart from this, why we have called this company is that Sanand backward integration. What are the key timelines? Currently, it has been scrapped, but will there be any other future outlook? Whether this integration will go up or not, that's what we'll be asking. And here it is. Pranav Bansal, the MD and CEO of the company, where we will be asking him a lot of questions. But apart from this, let's understand the details about the company. What's everything all about and what are the key details you should know before you go ahead of this KYC segment. Okay, so the company itself, let's just put out the key numbers. It's the largest stainless steel wire manufacturer in India, and in terms of volumes also we see it is a big player as well. The company is second largest steel wire manufacturer in India by volume, and looking at the installation, it's around 6.18 million tons per annum installed capacity, and currently as per the Q2 numbers ending, 74% of capacity utilization has come in and roughly 5,000 odd customers are also there. And also, let's see how the industry breakup is there of the revenue mix as such. And this is the breakup coming in. It's kind of even Stevens. Automotive is on the higher side. That's around 22% coming in, followed by general engineering, infrastructure, consumer durables. And I think more industries are there. The smaller ones includes cable, agriculture, poultry as well. These are the other industry, companies where there is kind of a support coming in, but a lot of miscellaneous revenue mix is also in place. Apart from the revenue mix, let's go ahead and see what else is in store. Yeah, just show the other thing. Yes, see the revenue mix. Largely the domestic one is 90 odd % coming in, and just a smaller number, that's around 10%. That's the revenue mix coming from the export markets. Also, the business update was there and stock was of course buzzing on that. The numbers year-on-year basis looks strong. Both of them are 30% odd momentum growth coming in. Sequential, however, on the lower side. But whenever you judge a company, there is lumpiness. So I have taken the year-on-year basis. The next phase of growth, this is very much important for the company. You should understand induction, hardened and tempered wires. We'll understand more from Pranav on this, why they're going into this segment. And this is the second one where the announcement and the capacity expansions are taking place. So this is something which we will be watching out for. But before we start, I would like to give you the rating parameters for the show. There are roughly 8 rating parameters where we judge a company. This also includes your income statement, your balance sheet, cash flows, the return ratios. These are one of the most important things which we take in focus. And now, of course, we see this is the important 4 parameters coming in. Apart from that, the remaining 4 parameters, they also include shareholders, street cred, analyst stake, and even outlook. Analyst stake is nothing but how much analysts are bullish on the stock, while street cred to define it's how the stock has moved, be it 1 month, 6 months, or even the last 5 years, to show you what the returns have come in. But the most important rating parameter is the outlook parameter. Also, apart from the outlook parameter, let's move into the first parameter, that is the income statement. And largely the history is just 2 years. That's why I've taken the 2 years CAGR numbers for this. Revenue and EBITDA, both of them, look at the numbers, what the growth has come in. 121% for revenue, and even for EBITDA, it's 100% growth. The H1 numbers also I'll get you in, but Q3 numbers were also rock solid, which I had mentioned earlier. Net profit has been significantly good as well. And Q2 numbers, look at it, revenue, that's up almost 12% sequentially on a year-on-year basis. These numbers are showing a good tick. But the profit, there has been some impact, and that is where my little bit of concern comes in. But net, the elevated margin levels is something what the company is coming across, and over the last 3 years, they have maintained this band around, that 7.3 to 7.5% margin band. So we'll ask Pranav, will this go and touch the 8%? So overall, for the income statement, I'll give a very, very strong thumbs up when it comes to Bansal Wires. Also, let's see the second parameter. This is also very much important, the balance sheet. And of course, the balance sheet itself, the company is going through a big capacity kind of a spending as well, and there might be some pressures also in the balance sheet. That's where I kind of have a neutral rating on this parameter. Largely, we see the borrowings, they have remained somewhat similar, but from FY24 it has come down around 700 odd crore rupees to around 600 crore rupees. You expect this to be a bit elevated only. The reason is company is going through big capacity expansion plans, and at times there are pain in the balance sheet, and eventually the return ratios you will see will be very dismal because of what the construct is happening. There are cycles, when you understand the company. Cash bank balance, nothing much to be there, and so it's a neutral rating for the balance sheet. In the cash flows also, nothing very significant coming in, but a little bit of concern definitely comes in from the operations and the PAT as well. And so overall, we have seen, given that a neutral rating, the return ratios which are coming in, those ROC, ROE numbers, that's where my concern also comes in. And from FY24, it's gone down to 15 odd %, and the ROE numbers also that we see, that's also gone down. So now I'll be giving this a strong thumbs down when it comes to the return ratios. Also, apart from the return ratios, the shareholding pattern, let's look at over here. That's around the promoters is stable around 78 odd %, and nothing much has changed for the FIs and DIs as well. But interestingly, the concern for this public, that's very low, and because of that, I think I would be giving this a thumbs down when it comes to the shareholding pattern. Also, apart from this, let's move on and show you something more for the shareholding pattern segment. After that is the street cred. That's also something we'll look out for. And just pull out the street cred, how the stock price movement has happened, and that's where the concern starts coming in. The last 6 months, stock is down 20%. Also, let's see stocks, how it has performed. Last 1 year is down 29%. So after 2024 September, most of the small caps, mid caps have fallen, and this company is also not that different from them as well. And that's why 5 years, of course, the listing history is less, so we have taken it around down 13 odd %. So this is the street cred also, and it's coming in with a kind of a thumbs down. But return potential is very much important, and around 5 analysts are tracking the stock. They have given a buy rating for it, and still from the current prices, a 44% return potential is expected. So that's why I've given a strong thumbs up when it comes to the overall analyst take on it. But outlook is something which everybody wants to talk about. Companies giving a lot of future related statements, and that is where a lot of our conversation will lie around, because future what lies for Bansal Wire is very much important. They're expecting a 30 to 40% volume growth in FY26, and also looking at the other growth parameters, they are reiterated the 20 to 25% long-term growth for the revenue and the EBITDA front as well. That's all we'll be talking about. And also looking at how the ROC numbers are panning out. They are looking at some good strength over there. If you could just show the other outlooks also. And that's where we'll show how the company is moving. EBITDA per ton that's targeted to reach double digits within the next 3 to 4 years. And that's something to look out for. Around 600 crore positive cash flows expected in FY26 and 27. And also a 25% plus ROCE business is expected by FY27. So these are the important outlooks, for Bansal Wire. But to give it in perspective more, talking with the management, I'd like to give you a small hint about the management for Pranav. Pranav himself, he started entering the business at a very young age. The promoter I'm talking about, Pranav Bansal, he's the MD and CEO of this company. In the last 10 years, he has been associated with the company, and he started off as an operator of machines in the company. So that's a very interesting history, and he has focused only and only on the business as for my conversation with him. But this conversation goes more now. Now I'm joined in by Pranav Bansal. He's the MD and CEO at Bansal Wires. A warm welcome and a happy 2026 to you, Pranav. To start with, Q3 updates. They have been on a very strong, momentum which has come in. The volumes are coming at lifetime highs. My first question to you is the volume growth outlook, what you have given earlier. Will you reiterate that guidance, or with a very strong performance, can we have an upward movement of this guidance for volume growth?
Sure. Thank you for having me. So, as far as volume is concerned, we started the year thinking that we would be able to do 30% additional volume. But after the first 2 quarters, we increased our guidance from 30 to 40% because that's what we are now looking at. And it looks positive. As of now, demand is good. We have good capacities coming on stream every quarter. So, as of now, I think I would like to stick with the 30 to 40% kind of a volume growth. Definitely, we will try to achieve the exact 40% number as well.
Pranav, that's an important update coming in. But Pranav, there's a concern also. Looking at the financials, the ROC, the ROE numbers, they are constantly under the pressure. And that's where my concern has also come in. And of course, you are expanding, and that's why we are seeing those numbers getting impacted. But when will these, ROC, ROE numbers, which are, down, when will they bottom out? Can you give us a period, next 1 year, 2 year, when will that happen?
Sure. So, in fact, as a company, if you look at our history, we've grown at 20-25%, but that has always been true that. Now, in the first 2 quarters, we have taken a very strong target for ourselves, wherein we are now looking at a 25% ROC number that we want to achieve within FY27. And the journey for that has already started. This is the first time ever this year that we have generated cash. That too, in the first 2 quarters, we've generated about 150 crores of free cash already. Our target of 600 to 700 crores for these 2 years, I think we are on track to achieve this or to better that as well. And as and when we do that, our ROC, ROE numbers would anyways improve. ROE, of course, because we have just gotten an infusion of equity. We are not tracking that as much as the ROC numbers because that's the core business. And 25%, I think, is a reasonable target. We should be able to achieve it within 27. We have already been seeing upward movement on that trajectory now, quarter on quarter.
All right, Pranav, that concern is definitely ticked down. But apart from that, the company is moving to specialty products. And whenever there is a company moving to the specialty products, the margin profile also changes. So I have 2 questions to it. What are these specialty products? There are some expansions also which have taken place, the IHT and the steel cord. So give us the more details about this, and how will the margin profile change once they start coming in?
Sure. So IHT is a new vertical that we've added only this year. These are very highly technical products and used for growing industries like for EVs, we've gotten IHT, and steel cord is one major product that is used in tires. And we are the only company in India manufacturing it now, the only Indian company today to manufacture it. So yes, these are high growth areas for us. As a company, we've grown at 20-25%, and in the future also we want to grow at 20-25%. That is where specialty will really add value for us. These products are products which take a longer approval process. So we are looking at maybe 1 to 3 years of approval, but we should start seeing numbers from specialty within the next year, definitely. And once you see those numbers, our margin profile will definitely increase. Our per ton EBITDA and the percentage of EBITDA both will start increasing.
We have spoken about the percentage growth, Pranav, but if you had to quantify that, don't give me an exact number, give me a range. Like right now, if your margin is at X for FY26, for FY27 or for FY28, what will be the margin change? And this will be a consolidated margin, if you could just give us that.
So, see, our business is structured in such a way that percentage of margin is always dependent on my raw material price. We have a cost plus model. So, if there is an increase or decrease in my prices, my the same is passed on to the customer. So, we are essentially acting as a converter of products. My margins are intact. Therefore, percentage is not something we track. On a per ton basis, we are at about 6 to 7,000 rupee a ton, and our target for the future in the next 5 years maybe should be to reach double digit here. From 6 to 7, we would like to go to 10,000 plus kind of a margin in the future. But that being said, honestly, the way we want to look at it, we want to grow at 20-25% even on the absolute EBITDA front. That's the main target.
All
Now,
right.
whether that comes from
Yeah,
5%
yeah.
or 10% does not make a lot of difference as long as I'm able to get 20-25%.
Correct, Pranav. But since you spoke about a lot of raw materials which are there in your company, the key raw materials, what are those? And are these prices also elevated as how most of the, you know, global prices are elevated across most of the assets? Is it same for you? Is any pinch coming in?
Sure. So for me, I have only one raw material, and that is my majority of cost overall. That's steel. And for steel, we have a pass-through model. We are a largely B2B business, wherein any increase and decrease there is in my raw material price is passed on to the customer with maybe a lag of 1 month, or in most of the products, the very same day. Therefore, if there is an increase in raw material or decrease, my business is not really impacted much.
All right. So there is a pass-through models. A lot of our viewers at KYC had written about how this business model of the company is working, and a lot of queries came on your customers. One of our viewers stated that 5,000 plus customers are there, and it's very difficult to track which are whose. But if you have a big customer, what does the customer profile actually looks like? These are all Fortune 500 companies, or these are basically your Indian companies which are the top 500 companies by market cap. What are these companies, and if any big addition has happened over the last 3 odd months?
Sure. So we are very well diversified when it comes to our customer base. We are servicing today customers from different industries, whether it is power and cable, automotive, consumer durable, general engineering, infrastructure. So we have customers all across. And one good thing here as well is that we have no customer centricity. So there is no customer that accounts for more than 5% of my sale. Therefore, that gives me a lot of power when dealing with a customer. I'm able to get the right price for the kind of service that we provide and the quality that we provide. Customers here would range from maybe a company buying 500 kgs a month to 1,000 tons a month. So that's maybe a 1 lakh kind of a 1 lakh product a month to about 20 crores a month. Those are the customers that we have.
And Pranav, the debt levels are elevated, and of course, companies going through important transformation as well. But will you be taking some more debt in FY27, or that's it? Some debt reduction will start now.
Hello.
Yeah, Pranav, you can hear me? Yeah, Pranav, I wanted to know about the debt reduction strategy for the company. It's still at
Yes.
elevated levels.
So, as far as debt is concerned, as I said, till now we have grown through debt. This is how the 20-25% has come in. But from here on, our focus is completely shifted to cash flows. Therefore, now we want to make enough cash flows to reinvest in the business and keep growing at the same pace. To grow at 20-25% every year, we need about 150 to 200 crores that we need to invest every year, and more than that should be our free cash coming in. So in the this year and next year, if we are able to generate upward of 600 crores, I think that should be enough to fund all our expansion. Therefore, we are looking at, in fact, a debt reduction going forward, even after growing at this pace from next year.
Yeah, and Pranav, one more query is there. What happens to your core business? Of course, stainless steel wire manufacturing is definitely there. You're going to value added. What's the ratio looking like? Current profile, value added, and your normal products, and maybe in the 2 years down the line, what will be the revenue profile if you just have value added and your normal business?
Sure. So today we have three main verticals that we operate in. Stainless steel is one of them. Stainless steel, high carbon, and low carbon products. So high carbon is a product majorly for automotive. Stainless steel is more consumer durable side of things, and low carbon is more agriculture and cable related, power and cable segment related. Now the fourth vertical is specialty wire, which will start next year. And if everything goes well, this has a potential to contribute a large chunk of my EBITDA and my revenue going forward. If a very aggressive or a very optimistic figure is that I would want specialty wire to contribute maybe 30-40% of my total business in the next 5 years. And I think if if we get approvals from our customers timely, I think we should be able to achieve that.
All right, so 40% revenue target is coming in for the specialty wire segment. That's what Pranav has stated. But for our viewers, I want to revise the KYC ratings which I had done earlier. I had given 8 parameters where I had judged the company, and largely I would like to say the income statement has been very strong, balance sheet, cash flow largely neutral, but the concern for the street is return ratios, and maybe that's why the street cred also is under pain, because largely we saw a big sell-off in the last 6 months in the stock. Stock is down 20-odd%. Shareholding neutral, but analyst is still bullish, all 5 of them, and the outlook, that's where the strength lies. So total KYC rating of this entire company comes out at 4.5 out of 8. But yes, the outlook is bullish. The management has also given a bullish outlook going ahead, but it will take time, 2 years, 3 years, for important capacities to come, the change in the product profile also. But just to end our conversation, Pranav, I would like to get you back in to this conversation. And Bansal Wire Industries, we spoke about the entire specialty segment, the commodity segment, or the core business which was there. But the Sanand integration, the company has actually put the plans off. That's what is there, if I'm not wrong. But will you try to regain this integration? Because whenever an integration project is there, that also helps the margin profile, or too many things at once for the company?
Sure. I think as of now, this was a very good decision that we took to hold off on that backward integration. That is really helping us focus on our core business, and in fact, I think that is the main reason why we've been able to increase our guidance and being able to perform better than our expectation. And without backward integration, I think our focus is now more on cash flow and return ratios. So first, I think our target would be for the first 2 years is to get 25% plus ROC. Once we achieve that, then we will start discussion of that.
All right. So there are 3-4 odd things, in this industry. But Pranav, this is a query for some young folks who always ask in KYC that if they want to start and come in your area of business, like you are also yourself a college dropout and you choose your passion. If somebody wants to chase their passion, what they do in your industry, in short?
Just work hard. That's all.
All right. It's very simple, 2 words, work hard, but it makes a lot of sense. Thanks a lot, Pranav, for your views on that, and the management showing their candor for the company and the growth outlook going ahead. Of course, the stock has taken a punishment. The stock is down 20% in the last 6 months, and the street might be taking the stress of the lower return ratios coming in as companies are going through capex. And interestingly, the company's utilization levels is at roughly 70 odd%. So the expansion capex makes sense. So these are how cycles play out when you do a business. So that's the entire management talking about it, and we have given 4.5 out of 8. So that's all, folks. For KYC, stay tuned to NDTV Profit.